Okay, good morning, everyone. Welcome to the Macro Snapshot. We are February the 10th, 2026, recording this in the morning. Okay, so let's have a quick look. One of the main things which we've got this week, we have a lot of data. So I've just got a summary here, just from Bloomberg of all of the data points. So this morning, or today, we've got the small business optimism sort of survey, which just came out. You see, we're just after 6 o'clock now. That actually came in at 99.3. So that came in a little bit on the weak side. So that's just something to tuck in the bottom of our and the back of our head. And remember that the data is going to be important just in terms of trying to give the sort of the mood and the direction for the US, for the US markets, especially because we haven't had a lot of data because of the government shutdown. So we start off with as I said, the small business optimism, which came in a little bit less than the survey, 99.3, which is also less than expected and less than last time. So that's not huge, but not great. Then we get the ADP weekly employment change that's expected at about 7,500 or so. We'll see. That was last time. And then what's going to be interesting, we start to get some other data at 8:30. We have the import price, and that's going to give us some information as to whether sort of tariffs are sort of having an effect and pushing up inflation. So look at the import prices index through the lens, through the optic of sort of inflationary pressures or not. So combine that with what we get from the CPI later in the week. Then we have the employment cost index also at 8:30. That's an important one because that's a quarterly number. Expected to come in at 3%. So expected to come in a little bit lower than last time. Last time we had 3.3, expected to come in at 3%. And that's important for the Fed in terms of inflation expectations because the employment cost index looks not only at wages and salaries, but also holiday pay, the costs of insurance, medical insurance costs, all of this stuff it's the employment cost. It's the total cost to an employer of actually having someone on their payroll. So that's a more comprehensive look than, let's say, average hourly earnings at the cost of wages and whatnot. So that's an important one for the Fed, and that will give the market a bit extra sort of information about inflation. Then, of course, we have retail sales. What's interesting is the core group and the control group. So be keeping an eye out for excluding autos and gasoline. And then the control group is kind of like the super core here. And as you can see, it's sort of positive, expecting, 0.4, something like that, which is, a little less than last time, but sort of indicating that the US consumer is doing okay. And I think I actually just pulled out a chart here from Trading Economics. I think I've got a chart here just of, for example, this is the core group. Sorry, retail sales excluding autos. I just pulled that out, and you can see it's quite a choppy number. So, you don't want to read too much into one sort of month, but the reality is that it's been relatively positive. And you can see last time I came in about 0.5 for November. So this is the December reading we're getting. So overall, it looks as though retail sales, the US consumer is sort of doing okay. So just getting back to some of that data. And then, of course, we start to get a bunch of employment data coming up during the week. We have the non-farm payrolls coming in tomorrow, apart from the ADP. And talking about employment data, which I'll talk about a little bit more tomorrow, but talking about employment data, what was interesting yesterday was that Kevin Hassett, who of course is Trump's sort of ally and close colleague, and is on the National Economic sort of Council. He basically said, "Oh, don't worry too much about slightly softer job numbers. There's lower employment growth, so hey, don't freak out about slower sort of softer employment numbers." So he tried to frame that as a sort of a general comment about sort of demographics and employment, but really what the market took from it yesterday and perhaps is taking from it is a sense that almost like a forewarning of potentially sort of weaker payroll numbers coming in tomorrow. So let's have a look at that because the US dollar certainly was pretty weak yesterday. I just wonder whether some of that, and also the front end of the yield curve, the yields went down a little bit, though the front end bonds went up a little bit. So I just wonder if Kevin Hassett, maybe even Trump, they have the numbers already, and that was just trying to sort of soften up the market for some softening numbers. Okay, so that's the data. Let's keep an eye on all of that this morning. That's most of that, apart from the small business optimism, which came out at 6, and at 8:15 the ADP. That's happening, but everything apart from that's happening at 8:30. Okay, what I want to talk about as well, just look at a few charts, is this whole sort of concept of sort of stock rotation. And what we're seeing here is that in a lot of the in a lot of the sort of indices, we're seeing that, sort of hovering around highs, just below highs. There doesn't seem to be a huge amount of direction, but actually underneath the hood, there's a lot going on. And I've spoken about this a lot over the last few videos, but I just pulled together a couple of things here, which is kind of interesting. So what we've got here in the black one. Now, this is 6 months, so everything's sort of indexed back to zero, and this is in percentage terms, going back 6 months. So this is performance in the last 6 months. And what I did here is sort of like a sort of a synthetic butterfly, this black one, which is essentially long QQQ, so long the general sort of tech index in a sense, but also long SMH, which is one of the semiconductors, and shorting in the middle, like the butterfly IGV, which is the software sort of ETF. So essentially saying, hey, if you sort of imagine if you were sort of shorting software, but going along the general index and going along the semiconductors, what would happen? And you can see here just the outperformance here, like a very, very strong performance in the last 6 months of that basket. So that basket would be short software, long semiconductors, and long sort of the general sort of tech sector. You see how strongly that's performed basically all the way up in the last 6 months. And then you say, okay, and compare that, let's say, to the NASDAQ, the general NASDAQ, which is the blue one. So you see here the NASDAQ or the QQQs, the ETF here, you see that's gone almost sideways. It's gone up a little bit. I mean, I guess up, well, actually it's gone up 6.82%, but compared to the basket of plus 30%. Now then, what about, let's say, just the mags, like the big tech behemoths, like the mag sevens, like sort of your Amazons and your Metas and whatnot. And you see that one, which is the green line, that's about the same as the broad sort of QQQs. That's gone up about 6%. And you go, okay, not bad, a little bit. But then you say, well, okay, what about the semiconductors just by themselves? So I've got, similar to the SMH, I've got the SOXX, which is the semiconductors. Boom, are you ready for it? There you go, the orange one. Now look at that. Look at that incredible outperformance up the last 6 months of almost 44%. So you can clearly see here, even within sort of the tech space, what's basically going on here is that the semiconductors is really powering ahead. Your NVIDIAs, obviously, and all of these kind of companies which are providing the hardware, doing very, very well. And then if you look just at actually what we can put on then is to look at the IGV just by itself. Let's just do that. So IGV, let's put that as the same percentage. And that's probably going to be not great news. Exactly. So there you see that. So you see the IGV, which is purely the software, is this pale blue. So look at this. So this is the pale blue is the software in the last 6 months has gone down 22% compared to semiconductors up 43%. And then if you look at the QQQs in the middle, up 6%. So you can clearly see here within the technology space that there are sort of winners and losers. And that's really the way to be looking at it. And so, if you look at NASDAQ, and you go, oh, well, it's sort of, doing okay. It's not really giving you a fantastic sort of a specific sort of sense of what's going on. And then, for example, if we look, just to put out a couple of other things, just to complicate the issue a little bit, why not? Let's have some fun. Let's put on the SPY. So we put on the SPY, which we all know what that is, and we look at how the SPY has gone. We can see here that the SPY, is done okay. I think it's this, it's this new purple kind of one here, up about 9%. So that's sort of slightly outperformed the MAGs, the MAG 7, and it's slightly outperformed NASDAQ. But you can see here the general stock indices are just, doing okay, but relatively flat. And then, we can look at, let's say, something like sort of the equal caps or the small caps. Let's look at IWM, which is the Russell. So just the final one here. So IWM, which is the Russell. Again, put that on same scale. And you can see here that this sort of golden one here, up 21%. So what's interesting, so this gives a pretty clear overview of just some of these rotation trades and really what's going on. So really, you say, just to summarize all of that, you can see the big winner is the semiconductors in general. The big loser is the software. And you can see that in companies like Microsoft. If you look at the chart of Microsoft, it's had a pretty large sell-off. Now, it's at an attractive level and could be a buy at some point. But just to say that, any companies which are really heavily involved purely in the software, providing software as a service, they're under a lot of pressure compared to the semiconductors. And then if you look at, let's say, in terms of the indices, you can see here that the Russell is doing well. The small caps, those sort of those kind of stocks are doing well. The equal weight indices are doing quite well. And then if you actually just look at the SPY and the QQQs and the Mag 7, you can see that they're doing okay. They're giving you sort of a 5 or 6 or 7% 6 months return, but nothing crazy. So that's an interesting chart to look at, and that's the way we have to be looking at some of the at the indices. So if we actually then just go back with all of that in mind, and then look at something like the ES. Whoops, we better get rid of all of these. So I'll just take these off. Otherwise, they'll be on every single chart. Just bear with me for 2 seconds. Boom. Okay, so now if we just go back and look at the futures here, you can see that doing okay, but we still haven't actually. So it's a 2-hour chart. Let's go back onto the dailies. You can see here that they're sort of relatively strong, as I say, up about 6% the last 6 months, but finding it hard to push above, and that's just because all of the subcomponents, some are up on the day, some are down on the day. Defense is up, aerospace is up, energy is up, our consumer staples is up, but then as you've got other things which are sort of down as we just saw. Anyway, but just at the moment, we had a relatively, we had a very strong day on Friday, and then yesterday grinding high. So, probably what's going to happen will depend a little bit on the data, which we just looked at over the next 2 or 3, 4 days. I think what the stock market in general probably wants is some sort of sense that that the Fed will keep on cutting. So what do we need for the Fed to keep on cutting? We probably need a labor market which is okay and stable rather than sort of collapsing, or on the other hand, which is too hot. So we're probably, at the moment we saw just from the Bloomberg sort of list that we're expecting about 70,000 new jobs for the non-farm payrolls. Probably the market wants something like that, 45, 50, 55,000. Nothing too strong. It doesn't want 150,000 because that would indicate maybe an overheating economy, a Fed which is less likely to cut. On the other hand, it doesn't want the labor market to be completely, collapsing, into negative territory, or sort of 5, 10,000 or minus or something like that. So in order for the stock market to keep on pushing higher, we do need to see broad strength in all of the sectors. We need to see a bit of a comeback from, let's say, IGV and the sort of the software. We need to see semiconductors continuing to get stronger. Nvidia is going well because the capital expenditure. We had Jensen Huang from Nvidia out the other day saying, hey, this capex looks a lot, but it's justified because this is a huge sort of technological revolution, and these big hyperscalers who are spending so much money, it's not necessarily a problem because there will be a return on capital, there will be a return on investment, and so it's all happy days. Of course, Nvidia's CEO would say that because, of course, the clear beneficiary are companies in the semiconductor space, such as Nvidia. So, as I say, the stock's just grinding up here. If we look at the NASDAQ, had, again, you see the underperformance, which we looked at in the other charts. And just keep in mind here that it still hasn't, got back to this sort of 61.8 fib retracement level. It still needs to push there. So definitely underperformance in the broad sort of NASDAQ. But again, looking at that earlier chart, you can see the reasons for that. There are sort of winners and losers within that space. Russell, the small caps, continues to do quite well here. And you can see that reflected if we look at something like the equal cap, the RSP, actually at new highs. Excuse me. Time for a little tisane this morning. So you can see here the small caps doing very well. So that's that. So probably enough there. I mean, as I say, just having a quick look here, you see that the semiconductor SMH doing very well. And again, just to drive home the point, boom, you see the IGV, which is the just the general software, had a bit of a bounce because it was very sort of oversold, so to speak. If you look at the RSI, as I was pointing out a few days ago in the video, I think maybe the Sunday video, anytime, this is actually a pretty easy trade because anytime it's been down, less than 30 on the RSI, we've seen substantial bounces. So not only did you have more or less at a support level, but you see here, very, very oversold. We had a nice bounce. You see oversold, you get a bounce. Oversold, here you get a bounce. Oversold, you get a bounce. So almost every single time we've breached that 30 on the RSI, we've seen a little bounce. But what I would caution everyone is this just a couple of things technically. You look at the MACD here, it's still not really turning positive. So the momentum here is, in terms of the MACD, the moving average crossover divergence, I mean, it's still pretty negative here. So let's not get too excited. And this just could be just a sort of reactive, technical, mechanical kind of bounce. And if we just throw on a couple of fibs here, just to put this into context, I'll put on my reversal fib. I mean, pick your poison. We could pick this one, but let's say I'll be generous and pick the shorter term one, just from the 10th of December here. And you can see just how far this has fallen and how far to go. So although this looks like a bounce and it was good for an intraday kind of trade, a 24 or 48-hour trade, just we're still a long way even from the 38% fib retracement would be up here, $91. Or even if we were to extend that for the full move down, you just see how far away we are. So the 38% fib retracement is at about $94. So we're still a long way away. Point is that let's not assume that this sort of software sort of a debacle sell-off is over. We really need to be monitoring things like the IGV just to see if there's still a bit of juice. Having said that, if we do start to get some positivity, over the next day or two or three in things like this index here, so the IGV ETF, that could be that would be quite healthy for certainly like the Nasdaq and the broader sort of a tech space and equity space. That would start a push a little bit higher. So that's definitely something to be looking at. Okay, talking about some other stocks, some interesting kind of stuff here. I just want to look at, for example, in Japan. Let's just have a look at Japan and global equity. We all know what happened in the Japanese election, big sort of victory for Takeichi. And again, we've had a second day of follow through, not only in the topics, but for example, here we have the Nikkei of large caps. So you see here the Nikkei pushing up. So that's the gap higher over the weekend on Monday, Sunday night. So we see here the Nikkei pushed up on Monday and also pushing an overnight trade higher. So the market liking what it's seeing over in Japan at the moment, is saying, hey, this is going to be stimulative, it's going to be good. But there are a few other things we need to be looking at. So, for example, another thing which is interesting is that if we start to get some foreign investment inflows into the Japanese stock market, and you have to think that, not all of this is domestic. I mean, probably some of this, at least, I don't have the exact numbers. 5, 10, 15, 20% of this is probably going to be foreign money. Remember, those foreigners are going to have to sort of, basically buy Japanese yen. So it's going to be interesting if at some point, and let's just have a quick look here over at, some of the what's going on in FX. So, for example, if we look at the dollar here, the dollar had a very, very weak day yesterday. So again, just from a technical perspective, if you look at the Fibonacci here, the dollar index, you can see here that it failed miserably at the 98%, not 98, no, at the 61.8%, but at the 98 level. So a big sort of Fibonacci fail here. And if we actually look where we could go, obviously the next, the easiest thing here would be a test downwards to these levels down here, around about 96. Something like that, 96.2. Probably the data is going to give us some direction here. If the data comes in weak, if we echo Kevin Hassett's comments that, hey, don't worry about the employment situation. The numbers are soft, but it's all okay. I don't think the dollar, the FX market's going to like that. And we could see some broader dollar weakness. And again, that also is being reflected in Europe. If we see the Euro index here, the EXY, that's also sort of looking quite good. The Euro itself, Euro USD, bounced off the 61.8% fib, but it now has a bit of overhead resistance. So on the other hand, let's also keep in mind that look at the resistance here on the Euro. If I can scroll back a little bit, where's that? Yeah. So you can see here, pretty key level here at about 119.15 on the Euro. So keep in mind, though, if the data is strong, no one says the data has to be weak. If the data is strong, so, payrolls come in fairly solidly, retail sales this morning come in well, the employment cost index is, a little on the salty side. All of that stuff could indicate that the Fed may not have to be too dovish. And that, of course, could cause, at these key sort of resistance points, something like the Euro could reverse. So it's all going to depend on the data. But just getting back to the yen, I've got USD JPY here, and you can see here that one of the narratives going into the election, the Japanese election, was that Takeichi, the prime minister, and the Liberal Democrats would actually be spending a lot of money. This is going to sort of worsen the fiscal situation in Japan. Horrible, horrible, horrible. But actually, I think that was priced in and discounted. And in fact, there is some sense now. The prime minister has talked quite a lot in the last 48 hours as well as the finance minister Katayama, essentially saying to the market, hey guys, don't worry, we're looking at the bond market. We understand there are some nerves around that. Any money to fund sort of expansion, a lot of that will not be through bond issuance. Any money needed to fund the abolition of sales tax. We've made a lot of FX. I was reading this morning, actually, a lot of the Japanese have made a huge amount of profits on FX. Let's just say their FX positions, because they have enormous amounts of foreign exchange. And just because of the depreciation of yen, they technically have made a lot of profits, up to I think it was 5 trillion yen or something like that. And so basically, Takeichi and the finance minister are saying, hey, we won't necessarily need to issue more bonds. And the market is quite liking that. And you can see here that the Japanese yen actually is strengthening as the US dollar is weakening against it here. So let's keep an eye. Any kind of weakness in the data in the US, weakness overall, generally in the US dollar, I think the Japanese yen could benefit a little bit, maybe even on some of the cross pairs. That's an interesting one to be looking out for. And we see that, just want to have a quick look here, just quickly at the Japanese bond market. I think it's JP 30, is that correct? Yeah, so if you look at the Japanese 30-year yield, you can see actually what's interesting here is that since the last few days, it's actually come down. You see, since the election, initially it had a little spike, but basically it started to come down a little bit. And you could say that, it peaked out before the election, about a week before the election, and it's actually calming down. So as long as those Japanese long-term yields remain even stable, they don't even have to come down a lot, but if they remain stable, that is indicating that the global markets are like, okay, we'll give Takeichi the benefit of the doubt here and not assume that she's going to do a Liz Truss kind of situation and sort of try and bring in programs which are unfunded and will require a lack of fiscal discipline. Now, is this long-term sustainable? Japan still has a huge debt. It's got to be interesting kind of tug of war. Because we can also see that in some of the other bond markets, there are some concerns. And if we go across to let's say other countries here, let's say look at Germany, look at the bonds here. So you look at the 30-year bond here, that is definitely pushing a lot higher at the long end, up to about 3.5%. Now compare that to the front end, you can see which is down. So this is the German 2-year versus the German 30-year yields. And you can see here the difference, a huge steepener here. And really the markets are basically saying, a lot of the markets are basically saying, hey, central banks are sort of contained, not really hiking that much, maybe even cutting, but definitely the issuance and the spending and the infrastructure and the defense spending is pushing up the long-term yields. So we're getting steeper curves, in a lot of places, in the US, in Germany, in France, also in the UK. So talking about UK, it's quite interesting to see what's going on there. If we look at the UK, you can see the bond yields are starting to go up a little bit. I think it's GB 30-year. Is that correct? Yes. So if you look at the UK 30-year yields, you can see here they're now at 5.3. So think about that, very, very high. No, not as high as they have been, but you can see in the last month or so starting to push higher. And one of the reasons for that is that there's quite a lot of political turmoil happening in the UK. Interesting in the whole Epstein thing. Essentially, how could I just explain this in 30 seconds? The UK, the Prime Minister Starmer appointed relatively recently a close friend of Epstein's as the UK ambassador to the US. This man has subsequently been forced to resign because one of the things he was doing, apart from having a lot of close contact with Epstein, was actually sending Epstein insider information, market-sensitive news from the cabinet room and whatnot. So he was forced to resign, and basically UK Prime Minister Starmer is taking a lot of heat for that. His chief of staff had to resign yesterday. So why is this important? This is important just because you see the bond market, because the bond market in the UK, we remember what happened to Liz Truss 2 or 3 years ago. The bond market is basically saying that if Starmer is forced to resign as UK Prime Minister, the only valid people to take over as Prime Minister in the Labour Party are more to the left ideologically than him, which could lead to more spending. More spending means more bond issuance, less fiscal discipline, a big problem. Bond yields are going to rip higher. And we've seen before with the British pound that that's actually had a lot of problems because of this lack of fiscal discipline and a bit of weakness. Now, you see the pound here. Excuse me, I have some more tea. You see the pound here is doing okay against the US currency, the dollar, but the pound against some of the cross pairs could actually be under sort of pressure because of this. So let's keep an eye on that. We see even, let's say, against the Japanese yen, the pound was down. If we look at the pound against the Swiss franc, you see how poorly it's been trading. So the point is, let's keep an eye on the pound, especially against the cross pairs, and any hint that Starmer is going to be kicked out as prime minister. A lot of machinations happening yesterday behind the scenes. That's going to be a negative for the pound, and it's going to be a negative for the British bonds or the UK gilts, which means that the yield's going to spike up. So definitely on the cross pairs, things like pound CHF and whatnot, that's going to be an interesting one. And if we look at, let's say, the pound euro, that's also the euro up a little bit against the pound. So the pound on the cross pairs under quite a lot of pressure. Right, in terms of some other things, that's basically it, guys. Just want to have a quick look here at a couple of other markets here. If you look at what's happening in the US, yesterday, you can see here that the front end of the curve, you see here the 2-year, the ZT was up a little bit, but compare that to, let's say, the 10-year, the ZN up a little bit, and the ZB. But really what was happening, there was a slight sort of twist, a steepening here, which these charts don't show in enough detail, but there was a slight twist steepening, which basically meant that the front end yields came down and the back end yields pushed up a little bit. You see here yesterday what happened. You see here the yields, you see the price going down, so the yields going up on the 30-year on that steepening. And that's just basically because there's a sense that maybe the US labor market data, remember the comment from Kevin Hassett, labor market data could be weakening a little bit. The Fed may need to cut a little bit more. So that means that short-term yields are going down, which is a negative for the US dollar. On the other hand, and remember that comment out of China, the Chinese regulator yesterday, essentially encouraging, forcing, suggesting to Chinese private banks that they should hold less US treasuries. That's not good news for the US Treasury market on the long term. So pushing up those yields. So let's watch out for that curve steepener here. Finally, guys, just want to have a quick look here at a couple of other things. I want to look at the metals. What we're seeing here, just quickly looking at volatility. If you look at the VIX, volatility coming down a little bit. Keep an eye on the move. So the bond volatility, we don't like that to be too high. As soon as that goes up too much, that's not great for equity. So let's keep an eye on the move index. But I just wanted to draw your attention here to gold volatility. You can see that it's still relatively elevated at 32. But it's down a lot from its highs of, let's say, 4 or 5 days ago. And similar kind of situation here, if we look at silver volatility, still extremely elevated at a 94 level, but it is down somewhat. My point being that as the volatility, in order for some of these metals markets to stabilize, they do need less volatility. That way, the institutions can come back because the institutions will increase their size as the volatility comes down. And you can see here the gold, starting to sort of push a little bit higher. Silver is still, I would say, in a sideways consolidation pattern, which is probably a healthy thing. We have the Chinese Lunar New Year happening, I believe, at the end of this week. That means all the markets over there, including the Shanghai Futures Exchange, will be closed for 1 week. So it could just be that silver takes a little bit of a pause here. But let's just keep an eye on the silver volatility, because if that starts to calm down and we get levels, coming in, around about this 70, 75,000 level, I think there could be some bias here because the big macro factors are still in place. And even remember that about 58% of silver consumption is actually for industrial usage. And we still have, electric vehicles, the electrification of anything, AI data centers, the grid, the electric grid, all that kind of stuff. All of this solar power, it all needs silver. So, the long-term reasons for silver and gold to prosper haven't gone away. So I do believe that if we get a sideways consolidation here in silver, we will get another leg up. Maybe not as crazy as this, but we could get a bit of positivity. Let's just have a quick look over at our friend Bitcoin, which continues to show weak price action. Again, even on this recent, the most recent down, and I'm being generous here with the fib. Look, if I put the 38% fib up there, you put it all the way up here. But anyway, let's be generous and just put it to the most recent negative impulse from measuring from, what's that, about the 28th of January. You can see here that even a 38% fib retrace was difficult to sustain. Point being, the price action remains weak. That's all I'm going to say. The price action remains weak. And still, what we'll need here to see is a basing formation. What does a basing formation mean? It means higher lows it means something, which is going to look maybe, whoops, won't look like that. It will look like, I'll put on my ghost feed here. It needs to do something like this where, we see some higher lows, just a solid base. We don't make new lows, and then we sort of push out, and away we go. And we start breaching 38%, 50%, 61 point, whatever percent fib. And that will look like slowly, we'll start to make a basing formation, and then, something like the downtrend, which could be something like that. Let's make that a 2. This is what you need to see. You need to see a basing formation, higher lows, and then we break out of some kind of downtrend, maybe retest a fib level, come back, doesn't make a lower low, pushes up to the 50%, comes back, and then that's what we need to do. And it's only until and unless we get that kind of price action that, in my humble opinion, the cryptos are buy. Now, one could be a rock star and come in here and buy it, but the point is that there's zero technical evidence that we've seen a basing formation here and that there's any sort of, I'm not even going to say positive price action. I'm just going to say solid or neutral price action. The price action here is extremely weak. It's as simple as that. And if we look at the EMAs here, the moving averages, you see they're all pointing downwards in a fairly aggressive manner. Now, can Bitcoin bounce because of some kind of headline or something? Yeah, absolutely. But I'm just trying to say the technicals are telling me that the price action is weak. Okay, guys, I'm going to leave it there. I'm going to grab a cup of coffee and a slice of toast. So that's it. Have a great day. Let's keep an eye, as I say, on all of the data, employment cost index, retail sales. And also I'll be looking today particularly at the dollar as it is against the euro, and I'll be looking at BTC, and also just look at all of those sort of interactions underneath the tech market between the semiconductors and the software and whatnot. Okay, have a great day. I'll be back tomorrow with the macro snapshot from the macro shop. Thank you.